Hey, future IAS officers, welcome back. It's time for another deep dive. Today, we're tackling something that's super relevant for the UPSC, both prelims and mains, and something that's been making waves in economic circles lately, India's household debt.
Yes.
We're dissecting the RBI's financial stability report, the one for 2024.
Right.
Freshly covered, of course, in the Hindu. So our mission today, going beyond just the numbers and understanding what this all means for India's economic stability and, of course, for different segments of our society. Get ready, because the report reveals a pretty surprising trend. It's not just about your typical housing and car loans anymore.
Definitely. It's interesting, right? The report actually highlights that household debt in India has gone up to like a substantial 42.9% of GDP. Now, just to compare, 2 years ago, this figure was at 36.6%. And it gets even more significant when we look at other emerging economies, right? Like take Brazil, for example, it's around 30%, or Indonesia, even lower, closer to 20%. So this sharp rise in India, it's kind of a signal that we need to dig a little deeper and see what's really driving this debt, and what it could mean in the future.
Okay, so 42.9% of GDP, that's a huge number.
Yeah.
But why should we, as, UPSC aspirants, be worried about this? Can you break it down for us?
Yeah, so basically a high debt to GDP ratio like this, can be a sign that there are some economic weaknesses hiding beneath the surface. Imagine like if a big chunk of people's income is going towards just paying off debt, what happens? That leaves them with less money, less disposable income to spend on other things,
Makes sense.
which can then slow down economic growth overall. So it's kind of like a domino effect, starting from those individual households and then impacting the larger economy.
So it's not just about like individual financial health, but actually like the nation's stability.
hmm
Now, the report also talks about a shift in borrowing trends, right? It's not just about houses and cars anymore.
Absolutely. We're seeing this notable increase in borrowing, but for consumption. So instead of taking loans to, let's say, invest in assets, things that'll appreciate in value over time, people are using credit more and more for everyday expenses and just like lifestyle choices.
So are we becoming like a nation of impulsive spenders? Is that what the report is suggesting?
I mean, it's not so simple. The RBI dives deeper into this trend and looks at things a bit differently. They categorize borrowers, right, as either prime or subprime.
Okay.
So a prime borrower typically has a good credit score, history of paying back on time, indicating they're financially stable. A subprime borrower, on the other hand, might have a lower credit score, maybe a less consistent repayment history, which might signal that they're potentially riskier.
Okay, that makes sense. So is this rise in consumption loans, is
Yeah.
it mostly coming from like prime borrowers or those
Yeah.
considered subprime?
Well, that's where things get interesting. The report says that a big chunk of these new loans are being taken by prime borrowers, which, on the surface, you might think, oh, okay, the credit market is maturing, but
There's a catch.
there's a bit of a catch. While that growth in prime borrowing is good, the report also uncovers something a bit concerning. There's this significant rise in consumption loans among lower income households,
Oh.
a lot of which fall into that subprime category. We're talking about households earning like less than 5 lakh annually. They're relying heavily on things like credit cards, personal loans, just to cover those day-to-day expenses.
That sounds a little alarming. Using credit for like basic necessities instead of investing in assets. That can be a slippery slope, right?
Yeah, it
It's
is.
almost like running on a treadmill. You're putting in a lot of effort, but you're not really getting ahead financially.
That's a great analogy. It shows a potential struggle rate to make ends meet, and that can have consequences, not just for those households, but for the whole economy.
Definitely. This is definitely crucial info for us as UPSC aspirants to get our heads around, especially because it could impact economic policies and, well, social dynamics, right?
Yeah.
Okay, so we've established that there's like a potential problem brewing here, but the report doesn't really explain why this shift towards consumption loans is happening, does it?
You're right. The report doesn't give one single cause, but it does ask some interesting questions that policymakers should think about, and of course, you as future administrators.
Yeah.
Could this be like a delayed effect from all the uncertainty during the pandemic? Like, are people finding it harder to manage their finances, leading them to, use credit for basic things?
That's possible. The pandemic definitely messed with a lot of livelihoods and incomes.
Yeah.
But could there be other things at play too?
Oh, definitely. The report also mentions how fast financial innovations are growing, things like buy now, pay later schemes.
Oh, right, BNPL.
Yeah. And those, while they seem convenient, can often kind of hide the true cost of borrowing, And they might encourage people to spend impulsively, especially younger folks who maybe don't fully grasp what it means to have debt in the long run.
Yeah, BNPL schemes are everywhere these days.
They are.
It's easy to see how they could be contributing to this whole trend, especially when they target people who might be more susceptible.
Exactly.
So given all of this, how does this debt-fueled consumption, how does it affect economic growth long term?
Well, that brings us back to this idea of the income multiplier. So lower income households, they usually have a higher income multiplier, meaning they tend to spend a bigger portion of their income.
Okay.
But when a lot of that income has to go towards paying off debt, well, their disposable income shrinks and they have less to spend.
And that reduced spending then slows down economic activity and it becomes this like vicious cycle.
Exactly.
Hard to break out of. This really shows how important responsible borrowing and good financial planning are.
It really does. It's so important for individuals to really understand what debt means and to develop those healthy financial habits early on.
Right.
And from a policy perspective, it highlights the need for, measures that promote financial literacy and encourage those responsible lending practices.
Speaking of policy,
Hmm.
what's the RBI doing to address this rising household debt, especially with these consumption loans?
Well, the report talks about a few steps they've been taking.
Yeah.
They've made it a bit tougher for people to get unsecured credit.
Yep.
They've tightened lending norms for things like personal loans and credit cards.
Okay.
Additionally, they're encouraging banks and financial institutions to really focus on prime borrowers, the ones considered less risky.
Hmm.
And they're keeping a close eye on lending practices to make sure, things don't get too risky.
But like a balancing act.
It is.
Trying to give people access to credit, but also making sure it doesn't get out of control and affect the whole economy.
All right.
But are these measures enough to really deal with the bigger issues, the structural issues?
That's the big question, right?
Yeah.
While these are good first steps, the report does say those structural risks, the ones tied to rising consumption debt, there's still a concern. It's going to take a more well-rounded approach.
Yeah.
Maybe focusing on strengthening those social safety nets, improving financial literacy even more, and finding alternative ways for lower-income households to save and invest.
Right. Because just changing lending rules might not fix the root causes, especially for people who are using credit because they have to, not because they want to.
Exactly.
And that brings us to another important thing we haven't really talked about yet. The impact this has on society, this growing difference in borrowing patterns,
Right. We can't ignore the social side of things.
Oh.
On one side, we have prime borrowers using credit to create wealth and build assets. But then there's this big group of lower income households relying on credit just to survive.
Right.
It can trap them in a cycle of debt and might actually make existing inequalities even worse.
That's a bit of a worrying picture.
It is.
If this difference in borrowing keeps growing and we don't do anything, it could widen the gap between those who have and those who don't.
Yes.
And that could affect social mobility and have long-term consequences.
Exactly. It's a complex problem with a lot of different sides. It needs a well-thought-out and proactive approach from both policymakers and individuals. Addressing those root causes, making sure everyone has access to financial services, and encouraging responsible financial behavior are all super important to reduce the risks that come with this trend.
This deep dive has been really insightful. So much good stuff for us as UPSC aspirants.
It is an important topic.
This is the kind of topic that's bound to pop up in our exams. And really understanding it, not just the surface level, will help us give good answers and form, informed opinions.
Absolutely. It highlights how economic trends, social stuff, and policy decisions are all connected. And that's key for the UPSC syllabus.
Okay, so let's do a quick recap of what we've learned in this deep dive. We're seeing, two sides to this whole household debt thing in India. On the one hand, borrowing is going up, especially among those prime borrowers. And that could mean, that the credit market is getting more mature. But then there's that other side.
Right.
The rising consumption debt, particularly among those lower income households, and that's definitely a bit of a red flag.
Yeah.
Could mean financial trouble, not just for them, but for the economy as a whole.
And this is really important for all of you UPSC aspirants out there. Imagine you're in the interview and they ask you, How can India keep growing economically while also staying financially stable with all this rising household debt? Or what does this trend mean for society and what can policymakers do about it? Knowing this stuff inside and out, going beyond just the headlines, will definitely help you answer those kinds of questions with real confidence.
For sure. This deep dive has given us a really good way to think about this complex issue, which could be, super helpful during the exam. So, to all our listeners prepping for the UPSC, what are your thoughts? What surprised you the most? What worried you?
We've talked about the bigger trends, but let's think about this on a personal level. What can individuals do, especially young professionals, future civil servants? How can they manage their money well in this ever-changing financial world? What steps can we take to be responsible and not fall into a debt trap?
That's a great question. I think it all starts with awareness, right?
Okay.
Understanding how credit works, budgeting, exploring different ways to save and invest. These are all key to being financially healthy.
Absolutely. It's about making smart choices with your money, choices that fit with your goals, because when people are financially secure and informed, it makes the whole economy stronger and more stable.
So true. We hope this deep dive has given you some good insights and made you want to learn even more. Be sure to check out the original article from The Hindu. It's got even more details. And please, share your thoughts. Any questions you have, let's discuss.
Yeah, leave a comment below. Let us know what you took away from this. You know what they say, sharing knowledge is like multiplying it.
And don't forget, hit that like button, subscribe so you don't miss out on more deep dives, just like this one. Specially made for UPSC aspirants. Keep learning, keep asking those tough questions, and stay ahead in your prep. See you next time. Good luck with everything.